Buy low, sell high. No, really. So hear me out here for a second. If you're a newer investor in the market, I bet that you're going to come out of this video learning something new and learning something valuable that you're going to be able to use in your whole investing career. So make sure you stick around. Okay, so 99% might be a bit of an over-exaggeration, but it's no secret that most investors in the market, even those that have been investing for a long time, don't follow this simple rule. And that rule, of course, is buy low and sell high. And today I'm going to explain to you exactly the psychology that goes behind traders in the market, kind of why we don't really follow this, even though it's obvious to look at it back in hindsight, and kind of teach you how to think differently from the herd so that you can come out profitable. So what I thought I'd do is I'd walk you guys through an example of a company that everyone's heard of, Apple, and this will kind of help articulate the point that I'm trying to make here. So looking at Apple's chart here on the screen, we can see that it's pretty obvious now to look back on the past price action and identify where the buy points and the sell points were in the stock. Logically, when we dip lower in the stock price, you're supposed to be buying shares, and when we go higher in the stock price, you're ideally supposed to be selling shares. This is how you end up with a positive gain and you don't end up with any losses in the market. But the reality is, with most investors, new and experienced investors, what ends up happening is the following. So as you can see from this image here, they end up buying at the highs and end up selling at the lows. Now looking back on this doesn't really make any sense. Everyone knows you buy when the price is low and sell when the price is high. Why would anyone buy when the price is high and sell when the price is low? If it's so obvious to buy low and sell high, have you ever stopped and wondered why so many investors in the market lose money? If it's so easy and so obvious, shouldn't we all be making tons of money in the market? Shouldn't it be kind of a no-brainer thing? When the stock price is down, you buy. When the stock price is up, you sell. So in reality, it's actually not that easy and not that simple. And that's because of one thing called emotions. Emotions are a very dangerous thing when it comes to investing. When you funnel your brokerage account with any amount of money, even if that's $1, you need to make sure that you leave your emotions behind. Making financial decisions based on emotions rarely works out in your favor. And the sooner that you realize this, the sooner you're going to come out being much more profitable and you'll start making money instead of losing it. So looking back on this chart, the reason that most investors buy when the price is high is because that's when it's perceived as safe to buy the stock. Things are moving up, the market as a whole is doing well, the media is pumping great news on this stock, stock's hitting new all-time highs, and this creates a sense of safety for investors to go and make their investment in a stock. Now, as soon as the price rolls over and we have something like a 5% down day in the stock, investors immediately look to sell their positions and get out of that stock. The question is why? Well, the answer is because that sense of safety that they had before is now gone. The media is kind of pushing fear out in the market. And of course, their emotions are playing a huge role in this decision. All of these things combined is pretty much telling them that if they don't sell the stock right now, the stock price is going to drop even lower and they're going to lose even more money. But what you need to remember is that you haven't lost a single penny until you hit that sell button on your brokerage account. If you're holding a position like Apple and the stock price drops 10%, if you don't sell your position, you're not at a loss. Technically, yes, your position is down, but until you hit that sell button, nothing is locked in. So you're actually giving that stock time to turn around, recover back to its highs to where it was before, and even move past that. Okay, so we talked about what investors do wrong here when we have, say, a 5% dip in Apple, but what are you supposed to do? Well, if the business fundamentals haven't changed and the stock is just down because, say, the market is down as a whole, or the sector is down, or there were some rumors, unconfirmed rumors that came out on the stock, chances are that this dip is only going to be some short-term pain in the stock. Now, this isn't always 100% the case, but if you think about it this way, if the fundamentals are strong today, and tomorrow we have a 5% dip in the stock, but nothing's changed fundamentally, why aren't the fundamentals still strong tomorrow? So what I would personally do in this situation, if I'm holding a stock and it dropped 5% in a day, I would actually be looking to add to my position. So what this would do is two things for me. So one, I just picked up more shares at an even lower price. So that's even a better bargain than I asked for before. Because when I thought whatever the price was at before this dip was a great value, now that it's 5% lower, it's an even better value. Think of it as like a sale at your favorite electronics store or something. If you wanted to buy a new laptop and it was on sale 5% off, wouldn't you want to pay that instead of paying the full price for the laptop? And the second thing that I just did by buying this dip is that I actually lowered my cost basis, and I've actually set up myself for a better position when the stock price does eventually recover, and I'll come out with even larger gains. So now if I do this consistently every time a stock price drops, say 3 to 5% or more, I'm setting myself up for true success here as long as the fundamentals and market conditions as a whole doesn't really go under and we don't enter something like a recession. Now, of course, if we enter a recession, this stock, along with pretty much every stock in the stock market, will start going lower. But the question you got to ask yourself is, what are you supposed to do in a recession? Buy, buy, buy. A recession is your perfect example of buy low. So as you can see here, either way you kind of come up on top as long as you're picking strong companies with strong fundamentals and you aren't thinking very short term. Stocks take time to recover, so don't let your emotions get the best of you and kind of convince you to sell a stock when you're down on a position. This is actually a key principle that I've personally been utilizing in my investing philosophy and my investing career, and it's actually proven to be a very successful strategy for me. Some examples that you can actually take a look at previous videos of mine was when Facebook had that whole Cambridge Analytica scandal. Nothing fundamentally, in my opinion, changed with the company, and I managed to scoop up tons of shares of Facebook at a huge discount. You can see the stock price is pretty much recovered now to where it was before this whole scandal came out, and this is typically what happens with most strong companies out there. Just remember that emotions and finances or money don't really go well together. They kind of butt heads. So when you go out in the market and buy low and sell high, you need to leave these emotions behind so you can actually utilize that strategy and take advantage of this concept. As soon as you recognize this, your investing career will not only be less stressful, but it'll also be a lot more successful. Don't forget to join our new Facebook group, Positive Investing, and follow us on Instagram as well at positive_investing. But either way, guys, thank you so much for watching. I really appreciate the support, but don't forget to invest positively.